Esteemed viewers of Money Deconstructed, today we delve deeper into a foundational pillar of the global financial system, a mechanism often operating in the shadows, yet exerting profound influence: debt. It is the very lifeblood of modern banking, the silent engine driving its intricate operations and shaping the economic landscape on a global scale. We invite you to join us on this intellectual journey as we meticulously dissect the role of debt, exploring its multifaceted impact on economic expansion and the distribution of wealth, ultimately questioning the inherent sustainability and potential for exploitation embedded within this dominant financial paradigm. At its most fundamental level, debt signifies an obligation, a formal commitment to repay a borrowed sum of money to a lender. This repayment typically includes an additional charge known as interest, representing the cost of borrowing. Within the context of the banking system, this seemingly simple concept forms the very bedrock upon which the entire industry is built. Banks, in their core function, act as crucial intermediaries, effectively bridging the gap between individuals, corporations, and governments possessing surplus capital and those in need of financial resources to pursue various endeavors. The act of lending, which inherently creates debt, constitutes the primary operational function of banks and serves as their principal means of generating revenue. When a bank extends a loan, it is essentially creating an asset on its balance sheet, the borrower's obligation to repay. The interest accrued on these outstanding loans forms the core profitability engine for these financial institutions, enabling them to sustain their operations and generate returns for their shareholders. Understanding this fundamental relationship between debt and the core business model of banking is crucial to comprehending the broader dynamics of the global financial system. The creation of money in the modern economy is intricately and inseparably linked to the concept of debt. Through the widely adopted practice of fractional reserve banking, commercial banks are legally permitted to lend out a significant portion of their deposits, retaining only a fraction as reserves. This mechanism, while designed to facilitate the flow of capital and stimulate economic activity, effectively leads to the creation of new money in the form of debt obligations. When a bank approves a loan and disperses funds, it is not simply transferring existing money. It is, in essence, creating new credit that enters the economic system as a deposit, thereby expanding the overall money supply. This process underscores the central and pivotal role of debt in the very fabric of our contemporary monetary systems. Without the continuous creation and circulation of debt, the current financial architecture would function in a fundamentally different manner. Furthermore, the complex network of interbank lending, where banks routinely borrow and lend reserves to each other, plays a vital role in ensuring the smooth functioning of this debt-driven system. Central banks, acting as regulatory authorities and lenders of last resort, oversee this intricate network, intervening when necessary to maintain stability and prevent systemic crises within the financial sector. Beyond the foundational role it plays within the banking system itself, debt serves as a significant and potent catalyst for economic growth across various sectors. It empowers businesses, both large and small, to access the necessary capital for investment and expansion, the acquisition of essential capital assets such as machinery and technology, and the pursuit of innovation through research and development. These investments, in turn, lead to increased productivity, the creation of new employment opportunities, and ultimately, overall economic expansion. Similarly, individuals utilize debt in the form of mortgages to acquire homes, a cornerstone of personal wealth building and economic stability, and through various other loan instruments to finance essential goods and services. This access to credit for consumption plays a crucial role in fueling aggregate demand within an economy, which is a fundamental driver of economic activity. When consumers have the ability to borrow, they are more likely to make purchases, thereby stimulating production and supporting businesses. Governments, too, strategically employ debt as a crucial tool to finance essential public services, invest in critical infrastructure projects such as transportation and communication networks, and implement fiscal policies designed to stimulate economic growth, particularly during periods of economic downturn or recession. The economic concept of the multiplier effect further elucidates this dynamic, illustrating how borrowed funds, when injected into the economy, circulate through various channels, leading to a cascading effect of further economic activity and growth that extends beyond the initial borrowing. However, the pervasive and often indispensable influence of debt within the global financial system is not without its inherent challenges and potential downsides, particularly when considering the issue of economic inequality. Access to affordable credit, which is a fundamental prerequisite for effectively leveraging debt as a tool for economic advancement and wealth accumulation, is often distributed unevenly across societies. A multitude of factors, including an individual's or entity's income level, existing wealth holdings, and even social standing, can significantly impact their ability to secure loans with favorable terms and reasonable interest rates. This disparity in access to credit creates a situation where individuals and communities with limited financial resources often face higher interest rates and less advantageous loan conditions, potentially trapping them in persistent cycles of debt and severely hindering their ability to accumulate wealth and improve their economic standing. Conversely, those who already possess significant wealth and have established creditworthiness often enjoy access to cheaper debt, enabling them to acquire appreciating assets such as real estate and stocks. This dynamic can further concentrate wealth at the top of the economic spectrum, exacerbating existing inequalities and creating a widening gap between the rich and the poor. Furthermore, the excessive accumulation of poorly managed debt within the financial system can lead to increased systemic risk, ultimately culminating in widespread financial crises and economic downturns that disproportionately impact the most vulnerable segments of society, often erasing their limited savings and further entrenching poverty. The intricate and often precarious relationship between debt and the global banking system compels us to engage in a critical examination of its long-term sustainability and inherent fairness within the contemporary economic landscape. Is an economic model that is fundamentally reliant on the perpetual and ever-increasing accumulation of debt truly a viable and resilient framework for the future? The historical record reveals the cyclical nature of debt accumulation, often followed by periods of deleveraging, financial instability, and potential economic recessions, raising significant concerns about the inherent stability and long-term viability of a system so heavily dependent on debt. Furthermore, a critical and unbiased analysis prompts us to consider whether this dominant debt-based financial framework inherently favors lenders and those who already possess substantial capital, potentially leading to exploitative dynamics within the system. The very mechanism of interest accrual, while arguably essential for the functioning of the current financial model, represents a continuous and often substantial transfer of wealth from borrowers to lenders over time. This dynamic raises fundamental questions about the equitable distribution of economic benefits within a debt-driven system. Exploring alternative economic models and financial architectures that might be less reliant on the pervasive and potentially destabilizing influence of debt becomes an increasingly pertinent and necessary area for thoughtful consideration as we strive to foster a more equitable, resilient, and sustainable financial future for all. In conclusion, our in-depth investigation has revealed that debt is far more than a mere financial instrument or a simple contractual agreement. It is an absolutely indispensable, albeit often invisible and poorly understood, force that propels the intricate machinery of the modern banking system and profoundly shapes the trajectory of global economies. While debt undeniably plays a crucial and often beneficial role in facilitating economic growth, fostering investment, and enabling consumption, its complex and multifaceted impact on economic inequality and the fundamental questions surrounding its long-term sustainability and inherent potential for exploitation demand our continuous and critical attention. We strongly encourage you, our valued viewers, to engage in thoughtful reflection upon the intricate and often paradoxical relationship between debt and our increasingly complex financial world, and to actively participate in further discussion and debate on these vitally important issues. Your diverse insights and informed perspectives are invaluable as we collectively strive to deconstruct the complexities of our monetary systems and build a more informed understanding of the forces that shape our economic realities here on Money Deconstructed.